Good afternoon, everyone. I can't see the attendee list, but on my side at least, but we're here to talk about access to capital issues within the cannabis space, specifically New York. With us today, we have Michael Weiner, F.L. Gorman, and Jeffrey Schultz, all cannabis legal experts within the space. We're going to first dive into an intro into why there are capital access issues within New York, as well as on a federal level, the country, get into what you need in order to prepare for financing, whether it be an equity raise or debt. And then we're going to dive into what is equity and then what is debt. To start, we're going to dive into this intro and realities of fundraising within the cannabis space. Let's start out really easily with federal capital access limitations, mainly found within the federal illegality of cannabis. And although cannabis is legal on the state level in New York and in other states, federal illegality does limit the available pool of capital to those who are willing to take on the investment risk. This risk in general is defined by the following. IRS Code 280E imposes an incredible tax burden on any plant-touching cannabis business. Specifically, it penalizes a state legal business dealing with Schedule 1 or 2 drugs by disallowing the deduction of ordinary and necessary business expenses, essentially resulting in federal income tax liability calculations based on gross income and not net income. So you have a really huge reduction in what you can deduct from your annual federal tax. As well as you have illicit market competition. As we all know in New York especially, you have a plethora of illicit cannabis shops, bodegas, delivery services, as well as delivery trucks or vans that you see out on the side of the street selling cannabis at undercut market values per ounce, per gram, per joint, or edible. And they're not getting hit with that IRS Code 280E tax overhead. It's all cash transactions, or at the very least, it's being written off as something else. That makes it pretty hard for a licensed cannabis business to even compete, which also keeps investors maybe away from the door, knowing that down the street you have somebody that's a stronger competitor, knowing that they don't have as much regulatory overhead. Another issue on the federal level, on the federal level, is you have no access to federal bankruptcy courts for a court-mandated dissolution or restructuring remedy. Creditors and investors are going to look at your business and think that maybe if things don't work out, what can they do rather to recoup their funds and at least maybe revive the business in the long run? You can't access federal bankruptcy courts, so you're going to have to look at out-of-court restructuring methods, which may or may not be the most effective way of getting money back, and therefore is another reason for investors and creditors to shy away from investing or lending to your business. Next, on the state level, specifically New York State, New York State has regulatory limitations on equity investments under proposed regulation 123.9J. So essentially, in shorthand, this is a restriction on investment dollars coming from any individual with any investment in any other cannabis license type in the country, besides for a retail dispensary to invest in a retail dispensary in New York. So what you're looking at is a lot of the larger capitalized out-of-state cannabis operators and investors are usually involved in a vertical license outside of the state. Think Florida, you have really highly valuable vertical licenses from grow all the way to retail, at least within the medical arm. And these investors that have a lot of experience within cannabis, a lot of market knowledge, and they're completely risk accepting of the cannabis industry with a lot of money to bring in, can't touch retail cannabis at the moment, at least under these regulatory limitations. So what you're seeing is a huge potential pool of capital out of the state is having trouble entering New York State's retail tier. Next, we have Essentials for Fundraising by F.L. Gorman. F.L.
Good afternoon, everybody. I'm just going to talk about some of the basics, and then we'll get into what is equity financing that Michael Weiner is going to speak on, and then Jeff Schultz is going to speak on the debt financing. So, some of the, setting the table before you do your equity and debt raises. A couple things you need, certainly company formation. Are you doing a C Corp versus an LLC? You should be working with an accountant, depending on, the particular function that your entity is going to have. If it's an operating company, certainly a C Corp seems to be the preferred way to go. A lot of times with the real estate might be held in an LLC. You're going to have a pitch deck, which you're going to give to, your investors, if you're looking for equity, and then a lender may want to see that for the debt. The pitch deck is going to have a detailed business plan with financial projections. It's going to have the key team members, the strategy, if you're a retail dispensary, it might talk about the location of the property, is it in a high retail market, a lot of traffic, a lot of nice co-anchored tenants like maybe pharmacies, Pandora, or not a Pandora, but a Panera Bread. And your pitch deck's also going to, set forth where you are as far as your state and local approvals, and your site control. Do you have the property under a binding LOI? Do you have a lease? Do you have a purchase contract? Do you have your conditional approvals from the state? A lot of the states like Connecticut and Mass, you got to get a conditional approval first, then you do your build out, and then you get your final approval. So, you'd lay that out in your pitch deck, and then it also would set forth, who the management team is, who are the advisors, and what their background is in the industry. You're also going to want to have a bank account set up, and that this, if you're already started this process, some banks will bank you, and there's a lot of banks that will not bank you, and it's going to take a little while to get your bank account set up. So, so you make sure you get, give some time for it. The banks, depending on who they are, they might want to do a site visit. They might do, beneficial ownership checks. In the banking world, they have something called know your client, know your customer, and there'll be some information they'll want to make sure they in fact do know your customer. And then be ready to, the banks are going to want to monitor, the cash, and where the money's coming from. And some of the banks that we've talked to and have worked with, they'll actually, essentially lock into your point of sale system so that they can actually, if you want to make a deposit for $100,000, they're gonna be able to trace that $100,000. So you got to get your bank account set up. Insurance, a lot of people ho-hum the insurance piece, but just like banking, there's a lot of insurance companies that are not going to insure cannabis operations. And a lot of states have admitted carriers and non-admitted carriers. And if you're doing your lease deal, or your lender might want a certain rating for your insurance company, and the companies that are insuring in the cannabis space, may not have the ratings that you want. So make sure you spend a little time on getting your insurance set up. You're gonna need general liability. Product liability is pretty big. Inventory insurance. There's definitely been some holdups, and I think in the papers the last couple of weeks they're talking about some of the big holdups in California at some of the dispensaries, and things like that should be covered by your inventory insurance. Equipment coverage, you got to have unemployment insurance, workers' comp, and then you most likely are going to have a disability and health policies for your primary employees. And then the banks and getting set up, you're going to want principals with good credit. And then what is your collateral package? If lenders are lending in the cannabis space, most of them are doing it with some, hard assets like the real estate. So what do you have as far as your collateral package? In most cases, licenses and inventory are not going to be permitted as collateral. So that's why, real estate's important. And then, what's your debt structure, outside of what you're looking for. Certainly you want to have good credit rating and low debt. So those are some of the essentials, getting your table set as you hop into the equity financing that Mike Weiner is going to talk about. Take it away, Mike.
Thanks, FL. So equity, what is equity? Essentially, equity is ownership of stock. It's simply stock. Obviously, it's a little broader than that. It can be something that converts into stock. It can be a contract that mirrors stock. And essentially, stock is, at its heart, is just a share of the profits of the operation. Often it comes with some voting. Doesn't have to, though. It's just a share of the profits of the company, either in the form of a contract or a security. As a result, not only do shareholders share in the profits of the company, but if you sell the company, they're going to share in the appreciation of the company, the growth of the company, so that when you sell the company, they're going to take a share of the acquisition proceeds, if there are any available for stockholders. Stockholders are junior to lenders, creditors, debt, and so essentially, if you sell the company, you pay your debts, you pay your creditors, and whatever's left over goes to the stockholders, however they have negotiated to do so. In the voting context, equity can be incredibly powerful. If you have protective provisions or veto rights or covenants with the company, you might be able to have negotiated blocking of certain transactions or actions of the company. In venture capital, protective provisions are quite common. VCs and other sophisticated investors want to prevent the company from doing certain things without their permission, such as selling the company, doing a financing, borrowing a bunch of money, or distributing dividends to the shareholders. They want the money to generally stay in the company and to help the company grow until such time as the company is able to distribute profits out to the equity holders. One thing to note that is very different in the cannabis industry from other non-regulated industries is that in the cannabis industry, regulatory agencies want to know who owns these operations. They may not look at the very smallest of shareholders or care, but for significant shareholders, they will want them to also be licensed. They will want to know if those interests are being transferred, and they may want to approve the new owners as well of the transferred interest. So something to keep in mind is that what is often a very easy transaction outside of the cannabis industry, a 5% stockholder sells their interest in the company to another person who will hold that 5% interest, can be quite a difficult transaction in the cannabis industry, because you'll need to go to the regulatory agency in order to approve that transfer. In positives and negatives in comparison to debt, the big one that, of course, jumps out is that, for better or for worse, equity holders are essentially holders for life. You never go away if you're an equity holder, unless you've negotiated some buyout provision, which is generally rare, but also in very small companies. As companies get bigger, those buyout provisions, you don't see those. So often shareholders are there forever. As an aside, I was talking to my mother about her stock portfolio. She has stock in companies that she inherited from her grandmother and still owns them as they pass through her parents to her. So stock ownership can be a very long time, for better or for worse. Debt, on the other hand, you have to pay back at generally a set time frame or on demand, and Jeff's going to talk about that. But having to pay that back can be quite terrifying. I borrow $500,000 as opposed to I receive an investment of $500,000. With the borrowing, if it's just straight debt, I have to pay it back. I need the operations of the company to generate $500,000 over that period of time, so I can pay it back on that at the time frame that it's due and payable. With stock ownership, I don't have to pay it back. I invest it, and it stays in the company, and they get a share of the profits until the company is sold, in which case they get proceeds. On the flip side, the flip side of having stockholders forever is they are there forever. And when you have a stockholder who no longer likes the vision of the company, or is very critical of management, you can't just say, well, here's a check, go away. Or if they're not doing enough to help grow the company in a situation where you've only got a few shareholders, you can't just give them a check and say, go away. They have to agree to that buyout. And of course, as I mentioned, the regulatory agency has to concur with what's happening. So there is a flip side to forever, which is you are locked in. It is more, if you do not have a buyout provision with a stockholder, it is more difficult to get rid of that stockholder than it is to get a divorce in the marriage sense. So it's easier to get rid of your spouse than it is a stockholder you're not particularly fond of. But there are some real positives, though, between having equity versus debt. Often debt will come with a security interest, a lien on assets of the company. If you fail to pay back that loan, they can scoop up those assets. They can foreclose on those assets. It might be all the assets. It might be a specific asset. Equity does not come with that because there's no obligation to pay it back. In a very real sense, there are no personal guarantees with stock ownership. In other words, if I'm a founder of a operation, cannabis operation or the like, nobody's asking me for a personal guarantee. Instead, I am getting together with other stockholders and we're going to go forth together in a shared enterprise, as opposed to I need to put my personal assets on the line to guarantee that I can pay back my loan. On the other hand, a negative for shareholders is that in some contexts, a shareholder or especially board members, but a majority shareholder might have fiduciary duties to their minority. I need to treat them fairly. That's about all there is, but a lender doesn't have an obligation to treat fairly the other stockholders of the company. It's a very simple transaction. I gave you money, give it back to me. If my recovery efforts destroy the company, that is just too bad. On the other hand, a majority stockholder can't just decide, well, I don't like my minority partners, so I'm going to do things to get rid of them and benefit myself. And the final positive, which should be clear, is that in most instances, with a stock ownership, I'm not paying interest on the stock. So if I sell 10% interest in the company, that 10% doesn't grow. And in fact, it is often diluted over time as new investors come into the company, meaning that as the company value increases, my ownership percentage goes down of course, the value is going up. But it is not growing because I'm not getting interest. In some private equity deals, which probably will not be applicable to most early stage cannabis companies, you might see accruing dividends that look a lot and feel like interest, and then dilute the other shareholders of the company. But in a general sense, most stockholders do not get interest. They do not grow their interest in the company. On the other hand, debt has interest, and that means that debt obligation grows over time, which makes sense. Essentially, if I borrow $500,000, I'm not going to just pay back $500,000. A year later, I might have to pay back $550,000. If I don't pay it back in a year, that grows again another 10%, and I'm getting further and further behind the 8 ball. No different than credit card debt. It just feels like over time that debt is growing and my obligation continues to grow. So again, equity is just sharing the profits of the company and sharing the ultimate proceeds in the company if the company is sold. And you are essentially taking on a partner, and that partner can be difficult to get rid of unless you've negotiated exits for you and your partner. So now I'm going to turn it over to Jeff to talk for a moment about debt.
Sure. Thanks, Michael. Appreciate that. That's a great explanation. So I'll go through some high level details on debt financing. I'll start by saying, the way to sort of break this world up into two is secured and unsecured debt. When you have a secured loan or when you borrow money on a secured basis, your lender has some sort of security or has a lien, has collateral over some sort of asset that you or the company own. That could be equipment. It could be, in many cases, your license. It could be your inventory. It could be your intellectual property. And in some cases, with a little bit more aggressive lenders, it could be your personal property, including your own home. I have seen that happen from time to time, particularly with early stage businesses and in cannabis where capital is a bit harder to come by. So, that it's an important detail. What is it that you want to put a lien on? I think in New York, you're not allowed to actually put a lien on the license itself, but there are legal ways to get around dealing with that. So, people get away with it anyway. In any case. And then you have unsecured debt, which is there is no recourse for the lender. If you default on the loan, you don't pay it back. There's not much that the lender could do but try to recover whatever cash is left in the business. As you can imagine, unsecured debt is more expensive than secured debt. A secured lender who's going to lend money to you but has a lien on, say, all of your equipment, knows that they have some limit to their downside because your equipment, they've assigned a value to it, that they know that if you can't pay back the loan, they're going to take that equipment and they're going to go sell it off for some amount of money. So they have some protection. So typically, if you take the same business and everything else is equal, everything being equal, a secured loan might be at 10%, where an unsecured loan would be at 13%. It's just going to cost you more money to not have any security on that. So super high level. That's the way it's looking. It's very hard to get unsecured loans in the cannabis industry, especially for early stage businesses. When you look at it from a lender's perspective, they look at your business and say, you haven't made any money yet. It's an unproven concept. No matter how much you try to convince people of it, if you haven't yet opened up your business, you haven't generated revenue and there's nothing for them to look to, they're going to be somewhat skeptical. It's the nature of the investment community, and they're going to price that debt higher, and they're going to want some sort of collateral just in case there is some sort of business failure. So and the other thing to note, if you are a secured lender, you're really at the top of the list. You're at the top of you're in the front of the line. If there's a default, you can't pay the money back, there's going to be an order who gets their money back. So it's going to be the secured lender gets all of their money back first, then the unsecured lenders or creditors. And that could be a lender. It can be your distro, if you owe money to the distro, or you owe money to a cultivator or someone else, you owe all those creditors money. And if someone lent you money on an unsecured basis, they are in the same pool as the distributor or the brand who you owe money to. And then the last is equity, which, you know, goes to the upside of borrowing money is you actually keep the equity. You don't sell your pie, right? You get to keep a bigger piece of your pie. You know, when you sell equity and you raise equity financing, you're selling a piece of your business, so you're going to own less. The question is always going to be, you have to balance whether you want to give up a certain portion of your equity at a certain price, and is it worth it, or is it better in that case to borrow money and take the shot that you can pay it back? And there's no right or wrong answer in any given circumstance. I think that this is more of an art than a science. And these are not binary options. I think that's really important to point out. It's not always going to be equity versus debt, one versus the other. There should be always a healthy amount. I think if you're taking all equity capital, you should probably consider maybe borrowing a few bucks, right? If you're borrowing, if you're doing nothing, but if you've raised all of your outside money just by borrowing it, and it's not that much, that's fine. But if you've raised a significant amount of money through debt, think about whether you want to sell some equity and maybe lower your debt service. One thing to point out, particularly in the retail world in cannabis, is David had glossed on is Section 280 of the tax code. 280E does not allow any cannabis business to deduct any expense except for the cost of goods sold. So your interest expense on a loan is not deductible from your taxes. So it makes that interest doubly expensive. It's twice as expensive as it would be if you were selling widgets or selling anything else in the world other than cannabis. So it's something to factor in when borrowing money. It's just another downside to borrowing money, that debt, it might look like whatever rate you're paying. For a normal business, that might seem like a lot. It's almost double that rate on an after-tax basis because you cannot deduct it. It is very expensive money. And another thing I really want to touch on before I get into sort of the pros and cons is really high level. The genesis of this webinar really was about predatory capital and just some commentary on what I've noticed in some of the regs and the TPI regs and the way that things have sort of started to shake out here. Predatory capital, by and large, comes in the form of debt financing, not equity. When you invest in equity in a company, you're generally aligned with the other equity holders, which are usually the founders. So you're usually in line with them. As the company grows, you grow with it. And as the value of the business goes up, so does your value of your equity, same as the founders. This is not true in debt, right? It's you know, your interests are not always aligned with your lenders, right? You owe them that money. You owe them by a date certain, no matter what, hell or high water come, you've got to pay them back. You don't want to be in a position where you have to decide whether you're paying your lender back or you're making payroll on that money. You're never going to have that issue with equity. And that's where the concept of loan to own comes in. I don't know if anybody's heard of this, but the concept of loan to own is a very, very much a predatory concept, which is the idea of I'm going to loan you money at an exorbitantly high interest rate, knowing that ultimately you probably can't pay it back. And eventually you're going to default on that loan. And I have a security or collateral package like your license or all of your equity. And when you can't pay it back, I'm going to foreclose on that loan and take your business out from under you. That is predatory lending. That is a loan to own practice. If you know, it's hard to sort of, it's one of those things you might see it. You might be able to see it when you see it, but cannabis is its own animal. The pricing of debt finance and equity financing is different than in any other industry. Borrowing money in cannabis in the low to mid teens is not abnormal. And that's another conversation about, excuse me, what are market rates for borrowing money? 10%, 12% might seem like a really expensive loan, but in cannabis, particularly in retail for a pre-revenue business or, excuse me, a mom and pop, it's not that high of a rate. If you can get that at 10% right now as a retailer, particularly if you're a card license holder, or if you're an AUCC, you know, it sort of depends on your own situation, but if someone would offer me that kind of money and I was opening up a dispensary in New York City and they offered me, even secured debt at 10%, I would jump on that. I would take 10% all day. I haven't seen, and I, just by way of background, I do a lot of capital markets work. I represent a lot of small emerging companies in the cannabis industry in their early stage financing, both equity and debt. I never see, and I haven't seen for quite some time, actually in the 5 years I've been in this business, have almost never seen straight loans in the single digits. I don't think it's almost never happened. I hope for that to be the case one day. Excuse me, I'm a little under the weather, but keep that in mind. I think it's really important that predatory capital doesn't always look the way it looks outside of this industry. So debt is expensive for all of us. Unfortunately, I wish we could all borrow money at 4, 5, 6%, but that ain't it. It's weed. So you have a lot of skeptical investors, and particularly people skeptical about the rollout of the New York market. So financing has gotten expensive. Look, some of the pros, like I mentioned, when you borrow money, that's money that you didn't have to raise by selling a piece of the business that you own. That's almost always a good thing, as long as you can pay it back. Again, you have to do the calculus yourself. And like I said, it's an art, not a science. You typically, one of the upsides is typically lenders don't have voting rights. They do not get to dictate how you operate your business on a day-to-day basis, and rarely get an opportunity to express any opinion on how you make large decisions. The exception to that is in loan documents, you will have covenants. Covenants are the equivalent of shareholder rights, where a lender says, in the loan documents, the lender will have the right that says, if you sell your business, I have the right to consent to whoever you're selling it to. I get to approve that. Or if you're going to, I lent you $1 million, if you're going to go out and borrow $2 million on better terms, or you're going to, collateralize some other equipment that you may buy in the future, like I need to approve that. There will be, that's where to look. If you're borrowing money and you're looking for sort of predatory terms, look at the covenants in the loan documents. Those covenants may end up mirroring what shareholder rights look like. And I see that very often, where people try to mirror shareholder rights, even though they're really just a lender. And they get a lot more say in the business than they would otherwise. And they justify that by saying, hey, I'm loaning you money. I get some say over what you do with it. Of course, there are market terms for all of this. And you can imagine reasonably a lender does not want you, for example, paying yourself a $10 million salary out of the gate before you've made any money. Or they're going to want to keep an eye out for affiliated transactions. Are you paying your brother, who's the contractor, $3 million a year for like a no-show job? Things like that. If I'm lending you money, I want to make sure you're not doing that kind of thing. So while there are protections that lenders want through those covenant packages, always keep an eye on those things, because sometimes they can get out of hand and lenders can overreach and really ask for things that really are not standard for lenders to ask for. Cons, look, you might not be able to pay that debt service. And as I mentioned, because of 280E, that overlay makes your debt service twice as expensive as it should be in any other industry. So if you don't think that you can, really meet that debt service, be very careful. And I'd advise everybody to be very realistic. It's very easy to succumb to the shiny object syndrome in this industry. We've all done it to some extent. Be real about your numbers and be honest with yourself about your projections and what you can do. And because if you're not, you might find yourself in a very difficult situation very early on, when you borrowed money and all of a sudden you find yourself very early on not able to pay back that loan, whether it's a loan from a private investor or it might even be from the state. Look, one more upside on debt is there's a risk that people take when they raise money early on in their business, and that's that they undervalue their business. The flip side of that is you raise equity and you overvalued it, and your investors are going to be really upset when your company is not worth $30 million, it's worth 5 or 2. So it cuts both ways. But look, one of the upsides of borrowing money is that you don't make a mistake early on and totally lowball your valuation and raise equity money at like some crazy low number. You gave up a huge chunk of your equity. You need to raise money down the road, and you're like, wow, I gave up half my company already. Like, what do I do now? That issue is exacerbated by the fact that if you're a card licensee, or any conditional licensee in New York at the moment, you have to maintain that 51% ownership. There's only so much of the pie that you're allowed to sell right now. I'm not sure how much OCM has put that, has considered that issue in putting severe restrictions around equity ownership and lending practices. But any license that is out right now in New York, any of these conditional licenses, you can't give up. You can only sell so much of your equity. So people who need to raise money are going to be forced to go into the debt markets, which are very expensive right now. Always have been. And I think the Fed raised rates yesterday, so they keep going up. But that's pretty much all I got. I'm good for Q&A.
Awesome. Thank you, Jeff. So we are currently open for Q&A. All the speakers and their emails are listed on this slide if you want to reach out to anybody. But if anybody wants to raise their hand and ask a question or type a question within the chat, please go ahead.
David, I wanted to just reiterate a point or amplify a point that Jeff made about equity. One of the hard things about raising equity is you do have to value your company, and obviously the two most common mistakes are undervaluing and overvaluing your company. People focus most on undervaluing, which is I'm really scared about giving up a big chunk of my company at the early stages where I raise 500,000, and if I give up 20% of my company, I'm really down the dilution rabbit hole. And when I have to raise a couple million in the future, I'm really going to be diluted, which is exacerbated by the fact that right now you have to stay over 51%. But just as problematic is overvaluing the company, saying, well, gee, I think I'm worth $9.5 million very early on, and therefore when I raise 500,000, I'm only giving up 5%. It's easier to get out of the undervaluing problem than the overvaluing problem, because essentially when you overvalue the company, you end up chasing higher valuations and closing off what you think of as low valuation financing going forward. I have a client right now, not in the cannabis space, that has basically several years ago raised money at what is clearly now too high of a level. And they are doing so many things to try to avoid doing a financing that will essentially wipe out their common stockholders, their founders, all because they raised money at too high of a level in the past, where if it had been undervalued, okay, you gave up a little extra, but you can still move forward and close additional financings. So I just wanted to reiterate that point that Jeff made.
Thank you, Michael. We have one question in the chat. Are there any banks in New York that work with plant touching businesses? I personally know that Valley Bank does. If anybody else has any additional banks they want to list off.
Dime will do it. Dime will bank. I don't know how much. There's a limited number of banks that will lend you money. Super limited, super limited. But I know that they'll bank it. Wallkill Valley will bank cannabis. East West. Park Banks in New Jersey, which has been very helpful. But Dime's been great. I've used them a lot.
I know Canandaigua National Bank in the Rochester region has provided debt financing for real estate where one of the tenants, is a very hopeful retail dispensary. And I know Evans Bank is looking at the space as well. And I believe Five Star Bank may entertain some clients in the area.
It actually made me think of something that I didn't really touch on with debt. Is it's not as simple of a world as it may seem, where someone's just willing to give you money for whatever reason, right? You might be able to borrow money simply for working capital purposes, but there are other ways to borrow money that are much, that are more strategic. And I break that world into a couple subcategories, right? You can get, in many cases, straight up equipment financing, right? You need to buy equipment. There are lenders out there that will lend you money solely for the purpose of buying equipment. Those will always be secured loans, because what they're going to do is they're going to put a lien on the equipment. Here's $1 million, go buy the equipment. If you don't pay me back, I take the equipment. It's mine, right? It's looks a little bit like consumer financing. There's real estate financing. Perhaps I think we had talked about this sort of when we were prepping, but if you own your real estate, and you're fortunate enough to own it, you can get a mortgage on your property, or you can sell it to someone who will lease it back to you for a very long term. And I don't think there's too many people in that situation necessarily right now, but some other options, you can get inventory financing. If you're a cultivator or manufacturer and you're sitting on inventory, you can often borrow money and against that inventory. So if you have say you got sitting on $3 million worth of inventory, you might be able to borrow $1 million, and somebody will collateralize that $3 million of inventory until you've sold it off. And then one that I think we'll see a lot of in New York as the market matures is factoring or true invoice purchasing, which is great for the supply chain. So if you are selling to a dispensary and you sell them on net terms, and say it's net 30 or 60, there are people that will factor your accounts receivable. Say I sell one dispensary $100 worth of product, I sell on net 30, and I sell another dispensary $100 worth of product on net 60. Those net 30 terms, I can go to a factoring business. LeafLink Financial does this. So LeafLink has a subsidiary business that does factoring. Now, what that means is if I'm on the supply side and I sold someone $100 worth of product, LeafLink might come and buy that product from me, or not buy it from me. They'll buy my account receivable from the store at 98 cents on the dollar. So they'll pay me $98 now. I don't need to wait 38 days or 30 days, right? LeafLink now goes and collects that money from the dispensary. That's their obligation now. I've sold my account receivable. Right now, if my terms are net 60, it's worth a little bit less to, in this case, say LeafLink Financial, and they'll give me 96 cents on the dollar. So instead of waiting 60 days to get paid by the store, I can get paid today, but I have to take $96 instead of 100. But in many cases, in order to keep your business operating appropriately, I'd rather take $96 today than wait 60 days for 100, because I need to I just need to keep operating the business. I need that OpEx. That is a form of debt financing that will be available, and I really think it helps grease the wheels in the supply chain, particularly in a market that's going to be that won't be vertically integrated.
And I just wanted to add something on the financial projections. Some lenders that are exploring this area that maybe lend in different states, they often look at what the projected gross amount of sales is for that state. And a couple of weeks ago, I saw, there was a report circulated by one of the big MSOs projecting that the sales in New York were, somewhere between $5 and $7 billion. And I saw this morning on Green Market Report an interview with Axel Barnaby, and where he was projecting up to maybe 3,000 stores in New York. And so just doing that macro analysis, $5 to $7 billion. If you had 3,000 stores in New York, a lender may look at it like, okay, carve up that $7 billion. That's like $1.6 million to $2.3 million per store. And that's actually a pretty low revenue figure. I think there's some of the bigger operators that feel like 8 to 10 million is really the break-even point. If you only had 1,000 stores in New York, then maybe you're talking about 5 to 7 million in sales. So That's, as we're trying to figure out how many stores are coming online in New York, and when you're preparing your pitch deck and your financial projections, you need to keep that in mind. How are you going to grab market share?
Yeah, that 5 to 7 billion number seems optimistic.
Right.
It sounds like that assumes a conversion of a significant amount of the traditional market, and I think that takes years, if not decades, especially
I think
in New York.
it's like a push-pull. The more legal stores you have, the more difficult it will be for the gray market to survive.
Yeah.
Awesome. Well, thank you, everybody. Does anybody else have any questions they want to ask the panelists? Gonna keep this question and answer box open. And do the panelists have anything else they'd like to add on top of what they've already spoken on? Take that.
I mean, I see a lot of the debt equity combo. Somebody's providing debt, but then they also want some warrants in the company, board seats. They look at it, they're protected on the downside with the debt, but they want to share on the upside in the equity because, it's so hard to find money in this space right now.
Yeah, actually, it's a really good point, right? And it's very common cannabis. Almost every debt deal I work on, there is an equity component to it, right? People want lenders. If you're going in as a lender, you have some downside protection, right? There's a limit to how much money you're going to make on that investment. There's also a limit to your downside. If you're an equity investor, you have in theory unlimited upside. You also have unlimited downside. It could be a zero, and it's cannabis. A lot of zeros. I can speak to that firsthand. So it's something to take into consideration. The one thing that we didn't really touch on that goes to the difficulty around the valuation conversation and how you raise money there, right? If you try to raise it at a super high valuation and you're worried about, giving up too much of your business, you might end up also, we touch on it, but among other things, you might end up shooting yourself in the foot, right? You have to be somewhat realistic about that. It's a little hard. Price discovery is very difficult in this industry, meaning it's very hard to tell what your business is worth right now. It's a new market. It's cannabis. It's just, there aren't a lot of comps. What's the business really worth? It's very hard to tell. There are so many assumptions you need to make. But what I've seen recently in the space over the last, really in New York in the last 2 to 3 months, are wildly optimistic and very unrealistic valuations, particularly on the retail side. And that has cost a lot of operators investment dollars where they could have raised at what I would consider to be a reasonable valuation. But instead think their one dispensary is worth like $60 million. I have news. It's not. And no one's investing in your business, in your one store, thinking it's worth $60 million. Not today, right? Actually, the best case is that it is worth that one day. And you have to think about that realistically. An investor needs to make money, right? They want that upside. They're not giving you money. In most cases, it's charitable cause. They want a return on it. So if your best case scenario, your business is worth $60 million in 2 years and you hit all your projections, well, that's the point, right? So an investor gives you money and hopefully in 2 years, it is worth that much. So they need to get a lower valuation today. And investors look at this as, their view is, I want to be compensated for the risk of funding your business before you've had a chance to prove yourself. And so there's some push and pull there, right? So while there is a risk that you undervalue your business, and when you raise equity money, there's a huge risk that you overvalue it and you end up not raising the money that you want because you weren't realistic about your own valuation. There is a solution that is the most common thing in early stage financing, cannabis and everywhere else, which is called a convertible note. This is maybe like financing 201. But a convertible note is a loan that converts into equity, right? And the reason why it's a loan that converts into equity is because, keep it very high level, it's a way to punt on the valuation conversation. Hey, I want to invest in your company. You want to take my money. I want it to be an equity investment. We want to be aligned and ride this thing together. I want all the upside of equity, but we just are never going to agree. And maybe we agree that there is no way to get to a normal valuation today because you haven't even opened your business yet. Well, how do we solve that? We solve that by doing a convertible note. So I give you money, it's in the form of a loan, and in a date in the future, say within the next 3 years, when you do another round where you say raise equity money, or at a maturity date, say in 3 years, there's going to be a valuation set on the business, and my loan turns into equity at that date at that valuation. So that is extremely common. I bang those out all the time. Companies big and small are raising money through convertible notes constantly in and outside of cannabis. So if that starts to come up in conversations you guys are having, don't think it's off market or strange. It's probably the most common form of early stage financing anywhere in the world, particularly in the US and Europe. Everybody's familiar with it. Everyone in Silicon Valley does it this way. There's a couple other tricks. You can do some other kind of contracts, but by and large, the convertible note is a very common structure and does a very good job of addressing the valuation stalemate that comes up.
The one thing I would add to that is most convertible loans are intended to be equity at some point, but we've punted on the valuation question today and given downside debt protection during the interim. But keep in mind, that is the intent. It's very rare for a situation to arise where you get to the financing, you have a terrific financing in place, and the investor goes, I just want my money back with the interest. It really is the intent that that loan is going to convert. And if there's misunderstanding on that, that can create real havoc for the company.
And further to that point that the investor wants their money back, and I think Michael made a good point that if you're equity, you could be in the deal as long as Michael's family's in those public stocks. But generally speaking, when you're seeking equity, most equity players, they want to be out in 5 to 7 years. So when you're doing your business plan and your pitch deck, you have to have reasonable valuations, and you have to show, what that exit strategy is going to be in 5 to 7 years, because you're competing with, equity investors and, straight up real estate deals, maybe in other M&A transactions. So, I think you got to show a return. You got to show, what the return is on capital and what their, projected internal rate of return is, and how that's going to be achieved if in fact you want to grab those equity investors.
We had a question in the chat. Has the SVB situation and Signature Bank, is that causing issues for cannabis currently?
Not yet that I've seen, but it's rippling through, and I would just be very careful. Like what I have advised clients to do is, and I'm not giving this advice to anyone in particular, but certain clients in certain situations, move money around. If you have multiple bank accounts, make sure that if you have an account that has under $250,000 in it, fill it up, and just make sure if you have the opportunity to put 250 grand into an account, do it, because the less you have above 250 in any particular account, the less risk you're really taking. There's a couple issues here, right? The regional banks are the ones that are currently in trouble right now, and this is going to be a sustained issue. There's like no question in my mind. If this ends tomorrow, I'd be shocked. But we have a systemic banking problem for a variety of reasons. It's the regional banks. The problem there is that there's a tremendous amount of overlap with cannabis. The only banks that will bank cannabis happen to be the regional banks. So the banks that tend to be in trouble right now are the banks that bank cannabis. Any bank that banks cannabis is, going to be in that zone. So there's a little bit of an issue. I'm not saying anyone in particular, any bank is in particular is in trouble. I don't know, but there is a lot of overlap here, and that scares me a lot. So a couple of things could happen. The bank gets shut down, and you can only pull out your 250. The rest of it, you might have to fight and claw for it. The other alternative is that what we might end up seeing is some of these smaller regional banks get gobbled up by the big ones. Now, what happens to your cannabis bank account if small regional bank gets acquired by JP Morgan Chase? Chase is going to shut you down because you're a tier one marijuana related business. They're going to shut down your cannabis bank account. What do you do then? They'll probably give you a minute to do that, to pull your money out, but no one wants to be in that position. So I'd recommend everybody have at least 2 bank accounts set up. Just have those redundancies set up should all those things happen. The silver lining is that the cannabis industry is the only industry in this country that is actually operationally prepared for this, because we can take our money and put it in a vault. And no other business is, I think, culturally prepared for it or operationally prepared for that. Most companies think of taking all this cash out and putting it in a vault as like a crazy idea. And we're like, shit, this is what we do every day. Like, this isn't scary. So we have to live in this world. And I don't know. That's my 2 cents. I haven't seen a major issue yet today, but I won't be surprised if I see one in the next month or 2.
Awesome.
Yeah, it's on the deposit side, not the loan side, I think, for cannabis, because banks have not been doing a tremendous amount of bank type loans into the cannabis space.
Thank you so much for answering those questions. It looks like we're almost out of time here. I want to say thank you to the panelists for joining and speaking on these issues. Thank you for all the attendees for coming, attending, and listening to the talk. I'm going to close out the session now, but on the screen you have everybody's names and emails if you want to reach out and inquire further on specific issues. This is a complex issue in a complex space, so it's always great to retain a lawyer who knows what they're doing. And I want to say thank you and have a great rest of your day.
Thanks,
for having us.
David.
Thank you.
Bye-bye.
Bye.